Everybody, this is Jim at SP500chart.com. It's about 7 o'clock on Sunday evening, February 3rd, 2013, and I'm watching the Super Bowl. Took a quick break between quarters, between the first and second quarter, and really, I don't think there's a whole bunch I need to say in this um, update for Friday, February 1st, and also looking at the entire week, because really, for the past, we'll get into it. Never mind. Why should I say it now? I'll make you wait. Before I get into it, I need to remind you that the website and the video are for educational purposes only, and nothing stated at the site or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research. And please do your own research and make investment decisions that are suitable for your personal financial situation. What I mean by that is there's some people who can be down 100 grand before lunch and they're not freaking out. Matter of fact, it might be like you or me being down 200 bucks. So, you need to know your own tolerance for risk. So, even though that is sage advice, it is not coming to you from a licensed financial professional, because I am not a licensed financial professional. I'm just a guy that draws lines on charts. So let's take a look. The reason I say we can make pretty short shrift out of this today is because, guys, it's been the same story, if you'll allow me to use the term here, all year long. And that is from January 22nd, the day that we opened up. This market did not move up on the 2nd. This candle did not form on the 2nd. We gapped to this starting position right here. And for the entire year, the market has been in this ascending channel. Now, we've had a little head fakes, and we've had some little ups and downs as we look at what has taken place inside this channel. But the larger channel itself, and the funny thing is, as far as channels go, it's not a big channel. But the channel itself has been working all year long, which begs the question, will it work for all of 2013? Most decisively, no. No, of course not. But it has worked so far for all of 2013. So here's our support line. Here's our resistance line. We have identified from time to time some little things going on within the channels. We had this little 3-day burst of momentum that happened back on starting from the low of the 18th, and it looked like that might form a reversal, but instead we formed a flat top there at about 1503 or so, around that area, and with that 1503 resistance, we identified that if we can get over this line, we should get to 1514. Instead, we got a little head fake, a little tribute to this line on support here, but later it gave way. The bottom line got broken, a little tribute of resistance right here, and then on Friday, the S&P powered up on the excuse, if you will, of the jobs report, I guess. I don't know. Guys, I want to say something right now, and I hope you'll bear with me, and this is not a political statement, but it is a factual statement, pretty much. It's my opinion, but I feel that a lot of my opinions should be relabeled as facts. But here's what I'm going to say. Do not confuse. It's my opinion that one should not confuse economic reality with market direction. Okay? Because look, guys, we still have 7.9% unemployment. That is the same unemployment that we had when the markets tanked in 2009. As a matter of fact, we have, I believe, fewer people in the workforce today than we had in 2009. Now, I might need to check that. I know that as of just a few months ago, that was the case. So basically, the labor participation rate has been shrinking. We have more people out of the job market than we've ever had. And part of that is due to aging of baby boomers, but part of that is also due to the fact that we're still just not making jobs. So, for what it's worth, people who have been trading on the fundamentals that the job market stinks, they have not been treated well over the past 4 or so years. So, the markets are the markets. Economics is economics. The reason the markets are going up is because there was because all the money that had been in the markets that could be wrung out of the markets got wrung out of the markets by March 9th, 2009. This was the panic bottom, the capitulation, the last of the die-hard hangers-on finally just said, forget about it, I'm out of this market. And at that point, when the most patient people imaginable got out, that signaled bottom. So the reason the markets have been going up is because the markets for the past 4 years have not been able to go down. Now let me tell you one more thing here, and I'm not making a prediction yet on the direction of the markets long term. But I want to remind you, the length of the average bull market phase in the modern era, and we're talking, I believe, post-World War II, is roughly 42 months. I'm going by memory here, but let's call it on average about 4 years. The average length of the bear market, which would be defined as any market decline 20% or more. The average duration is about 18 months. Let's go back to our 3-day chart here. And what I want to show you, here was our market top back here in fall of 2007. Let's count how many months. That's 3, 6, 9, 12, 15, a hair under 18 months it took to take the money out of the market, if you will. This was the squeezing of the sponge as pain separated people from their market positions. On average, it takes longer than that for the markets to then absorb the money back in. The book that I use for a lot of what I do here, Technical Analysis of Stock Trends by Edwards and McGee, they make the comment in there that stocks spend about 70, I believe this is about the comment, spend about 75% of their time going up and 25% of their time going down. So if you look at any stock chart, you'll see a typically, unless it's a biotech, typically you'll see an accumulation of shares over time, and then when you see the sell-off, it happens 3 times faster. So that's what we have a tendency to see in the markets. And wow, look here. Let's go to a monthly chart. Look at all this time the markets go up and then boom. Now, albeit this was an unusual bull market right here. We had some big corrections, by the way. This thing right here, there's your Black Monday crash in 1987. But what's interesting is you can see that here we spend a lot of time going up, recovering from that first major top in 2000. We spent that actually took a little while to get that done, but then takes longer to recover, and then boom, it gets slammed down. Now we're recovering, and the question will be, what happens when we get up to these same levels that have twice proven to be strong resistance? But we'll talk. We got time to talk about that right now. As we look at what happened during the week, all I can say is we stayed in this channel. And even though I thought we would likely break this lower line on Friday, I'll confess I thought we would. The market had its other ideas, which, by the way, means I was wrong and the market was right. It's not the market doesn't know what it's doing. I had it right. No, no, no. I thought it would. I didn't do anything, but I was prepared for a break, and if it had broken, then you probably get a back test and you know what to do. But we bounced on this bottom line, and now I would expect us to probably head on up, get up into the 1520s. That would be my guess. But I want to tell you that our little pattern here that had our resistance at 1504, that small pattern pointed to 1514. Remember when we measured the height of it? We measured it right here to there. We said wherever it breaks out. Well, actually, I think I measured it from this reaction. So wherever we break out, we can expect to move to about 1514. And it looks like we got our move to 1514. But seeing as how we have a number of trading days under our belt that could serve as a base, I would not be at all surprised to see the S&P get on up to the very low 1520s. Now you'll see this brown line right here. I want to show you where that comes from. That comes from, I'm not really counting this as a top, but that comes from the last two tops that we had in the S&P. And I'm thinking that's probably going to send the S&P down, at least for a while. So I don't think it'll be a major correction, but I think we could very easily find resistance at this level up here, which is in the right now in the low 1520s. So that wouldn't surprise me as we come into this week and we don't have that far to go, and we start to tag that brown line. So let's see if the S&P has the gumption, has the steam left to climb on up, put on another 9 or 10 points early this week, and tag this area. Then let's see if it gets turned back down. And if this is strong resistance, then we should see, upon tagging that, assuming we tag it, we should see then a move back down that should have sufficient momentum to take this channel out. Because this is a bigger, longer lasting trend line, it should turn things back. And if it does, then we start looking for where we would expect some support. But right now, until we break this line, guys, I'd hang with it. If you're antsy, if you got good gains, and you're thinking, well, I'm think I'm going to play the chart. That looks like some pretty long-term resistance. Well, then, if you want to do that, then make up your own minds. If you want to sell at this point, the fact is this channel is really not very tall. I think I measured it last week, if we look at the top to the bottom, we're looking at a height of roughly 20 points tall. So we're only 1.5% tall, or less at this point, where we are around 1500. So if you say I'm not going to sell here, I'll wait for this to break, then you're probably gonna be giving up maybe one and a fraction of a percent in move or in gains in the S&P. So guys, that is the video for the week ending February 1st, 2013. Let's see how long this thing can work until it breaks. If it ain't broke, don't fix it. So guys, thanks for watching. Thank you for your support. And I just want to say this. If you like this kind of chart analysis, if you get something out of it, you can subscribe to sp500chart.com. It'll cost you $19.95 a month, and you'll get a video after each day's close, with rare exception. So guys, thanks for watching. Come to sp500chart.com, sign up, and take care.